we tend to leave insurance to when we get older. We feel like insurance will take its place when we settle down in life. But by the time you settle down in life, a lot of things may have bypassed you. And therefore, that preparedness when an unfortunate event hitting, they always catch us unprepared. And that is what we would want it to get to alleviate as a population and as a society. So when do you start? When is it? And this is the question that everybody would want to ask. When is it that? When is it the best or the most appropriate time to start in insurance? And my answer to this is as soon as you start earning a living, whether it is a wage or an allowance, the way we call it, or a stipend. It is important that we get committed and know and ensure that part of it is dedicated to insurance. And the reason why it is good to take your insurances when you are young is because insurance is dependent on age and your health. And I think I would want us to go through some presentations which I shared. If you allow me, I can share my screen so that we are able to follow and move together. And towards the end, we will have a Q&A session where we will answer the questions that will be there. Sorry, I'm being distracted a bit by those who are joining because I have to admit them. We get to a point where we have to answer questions when it is a little bit late in life. And I would want to share my screen. I can see we are about 13 participants, and I think we are good to start. If you allow me, let me share my screen. Is it visible? So what we are looking at is how to protect your family against loss of income. And I think a time like this, most of us have got experience when, especially during this pandemic period, when a good number of our society have been affected and also impacted by the ongoing pandemic. So there is a lot of disruption, and especially on income. And I would want us to look at, yes, I would want us to look at these slides and go through them and see what we can put together. The first one is just about myself, and I have, I think I have highlighted in brief, I'm an insurance professional, and I'm very passionate about ensuring that insurance is understood and it is easily accessible to all persons. And when we talk about all persons, I repeat again, it is not only people who are earning a salary. I'm looking at a period when we have got a very large number of our population, which is into self-employment. Yeah, and they also need to be accommodated in this is what happens when some people join late. So I'm admitting people and at the same time moving on with the presentation. Sorry for that. So I was just saying that we are in a situation where a good number of our working force is actually self-employed, and we should shift from thinking that insurance is for the people who are formally employed. If you are a mechanic and you're operating a garage, part of the income that you earn should actually be dedicated to securing yourself. And like when we started, I asked the question, for example, when do you secure your home when you are constructing? You start thinking about security of your home very early. And therefore, even if you compare that your life is also a project in the making, it is under construction, you should start as early as possible. And there are facts that I would want us to look at together. One of the facts is that insurance is the easiest way of creating a wealth. Reason being, you do not need to have some capital somewhere. You don't need to have a title to a land. You just need to have money in your pocket and have your life. The second greatest fact that I would want us to address is that the greatest asset available, and it is common to all of us, is life. And therefore, we have an obligation to protect it and to secure it. So this life insurance, when we look at it, is a long-term investment on your life or in your life. And it is best purchased when one is young, like we had put it. We all know and appreciate the fact that when you are young, that is when you are able to do most things. That is when you become an athlete. That is when you are able to fight. And that is when you are able to struggle. And therefore, it is also the time when your health is at its best. And because insurance is dependent on your health, it is the right time to take up insurance or to sign up for an insurance policy as early as possible. So, and like we said, insurance is for everyone. It is my conviction, and it doesn't matter your social status. It is important that each person is secured. What I have shown here is a demonstration that shows you are at a better advantage when you take your policy when you are young. I have taken the same life, all people within taking the same type of a policy, which is for a 10-year period. If you are not talking, please mute your, sorry, mute your mic. Yeah. So this, what I'm showing here is that when you are, for example, I look at a 45-year-old, look at somebody who was born in 1977, somebody who was born in 1987, and somebody who was born in 1997. If you look at them, the 1977 is 45 years old, sorry, today. And he wants to pay a premium, a monthly premium of 5,000 to take up a policy term for 10 years. This policy will mature when this person is 55. His benefit is 411,000, and I'm using an anticipated endowment as a demonstration for this purpose. The estimated maturity value for this person's or the benefit that he expects to get at the end of 10 years is 658,000. if you give the same product for the same premium to a 35-year-old, this person will purchase a maturity benefit of 674,000 at the end of the 10-year period. If you give the same policy to a 25-year-old, this person will purchase a maturity benefit of 677,000. And this is a clear demonstration that the person who is 25, of course, he will get his 677,000 when he is only 35. So even if he wants to use this money to boost his retirement equity, he has an opportunity to put it again for investment for about 30 years. If you take the 45-year-old, the 35-year-old, he will get it. He will get his benefits at age 45, and therefore he will have about 15 years to invest that money to, if he was to use it again to boost his retirement equity. The person who is 45 has only 5 years to invest that money in order to boost his retirement equity. And you see, if you are to use the power of compound interest, the person who is aged 25, and he has an opportunity to invest that money for about another 25 years, he will accumulate that benefit to a very high amount that is able to give him a good retirement package. So this demonstrates the fact that it is extremely beneficial and necessary that you get the knowledge on the importance of taking up an insurance policy as early as possible. And for those who have joined us late, we have said earnings are not necessarily from a structured employment, because not all of us will have the benefit of working in a structured employment. I think next time when we have the meeting, we should come early. Sorry for the disruption. Yeah, the next thing I would want us to look at is what is the risk of loss of income. And we are quite familiar with what is happening today. We have seen a good number of organizations retrenching employees or getting them to accept a pay cut or reduction in their monthly payment. You could also experience insufficient liquidity or loss of a major inlet for your business, especially for the business owners. I am keeping on admitting new people, so you will excuse for the disruptions. So when you are operating a business, say if you are operating a garage and you lose a major client for whatever reason, you will notice that it will drastically affect your income. And what we are saying is you need to have part of your money that you earn as a garage owner to purchase you an insurance. Just a minute. I'm admitting people who are coming late as we move on. Sorry for that. Okay. So on, Okay. Sorry, we are keeping on having to give attention to those who are waiting to join the meeting. Sorry, we were just saying the incidences that would result in a reduction in or loss of income. Then there is temporary or seasonal employment. This is a term that we are very conversant with, especially for our young people who are leaving, for example, college, and they start by working or doing seasonal jobs, or they call them the attachment program, where you are given an income. So you should not treat that income as temporary. It is only the job which is temporary. The income is not temporary. Once you have earned it, it is yours, and you can plan for it and plan great things. And one of the best things you can do is to plan half of it, part of it, to go to your insurance. To go to your insurance premium, or to purchase an insurance benefit. So why is this risk? Why is it recommended that we insure this risk? The risk of losing income. Ideally, if you decide you will not take insurance, it actually means you have decided to self-insure. And when you self-insure, or you insure yourself, it means you bear all the risk that goes with any loss of income. In the unfortunate happening, in the happening of the unfortunate event. So what the insurance does is that it facilitates transfer of that risk. The moment you take up an insurance policy, you transfer the risk to the insurance company in exchange of premium, or a contribution, as what most of us would want to call it. What insurance does is to facilitate a pooling process of the premium that is paid. It is invested at a return, and a pool or a kitty is created, and it is from this kitty that claims are paid for those who need to have claims settled. Sorry. So what we are saying, I'm having some challenges. Loss of income risk, it needs to be mitigated. And if it is not, what happens? If you decide you live like that and you're not going to take up an insurance, what happens? It actually means if it is not insured and the unfortunate event strikes, what is likely to happen is that there will be a degeneration of your standard of living, because the income that you used to get in order to sustain and to manage your affairs is not available if the channel has been disrupted. There will also be a difficulty in meeting your mandatory financial obligations. And this could include your school's education, or the education of your children. It can also compromise your self-esteem. And also it could also lead to loss of family property. You imagine a situation where you have taken a mortgage to buy a house for your family, and you are living in it, and your income gets disrupted. What happens? It is very possible that if you are unable to continue remitting your mortgage repayments, your financial will not have a lot of that understanding, and therefore you are likely to find yourself having to surrender the property. So how does insurance mitigate this risk? We have several insurance policies that have been developed and tailored together with some riders to mitigate the risk of income loss. And this will include policies, like when you are buying an insurance policy and you take up an endowment policy, which pays a lump sum benefit on maturity or prior death. You can also take an anticipated policy that pays you partial benefit within the policy period. You could also take up an insurance policy that takes care of your children's school fees, or a term assurance policy which pays a lump sum benefit in the event of death during the policy period. You could also couple or add riders to those policies, and part of the riders could include accidental death, where death occurs but not as a result of ailment. It is sudden and something abrupt has happened and cut your life short. That is what running out of time. Accidental death, then temporary and permanent disability provides income replacement after the accident or illness. We have an employment rider which pays, or for example, it can undertake to pay loans in the event of death. So this is what happens if you take up a policy. You would contribute premium, you get payouts or partial payouts, and you get your final benefit at the end of the policy period. And we said this is the benefit that you use now to cushion or to secure your financial security. You could invest it in a money market. You could use it to say pay a deposit to something else, or even a deposit to purchase of a house or something like that. And in a nutshell, we are saying that income loss is very uncomfortable, and it is a very uncomfortable experience, and it has huge implications, and it should be prevented at all costs. So I think with that, we go to our Q&A. We can take the questions. Any questions? My screen is messing me up here. We are too quiet. Or we are alone. We are on Q&A. And just as we handle the Q&A.
I have a question.
Yes, sir.
I have a question.
Yes, please.
So when you take the, let's say you take one of the riders for unemployment here.
Yes.
For how long does the insurance kick in? Is it limited to a certain period of time?
Yes, it is limited.
Is it for the duration that you're actually out of, employment?
It is limited for a duration because it is expected. It's actually meant to give you time to adjust yourself and it could be 6 months. And that time the insurance company pays, for example, if you had insured a loan, they could repay the loan for 6 months consecutively. And it is expected within the 6 months you will have made arrangements to get an alternative employment or reorganize with the financial on how you are going to handle your mortgage repayments.
Okay, then in other instances, when you take that mortgage, there's usually a loan, or rather, they also insure it. They also insure the mortgage. The bank would get you insurance.
Yes.
So can both contribute to the same mortgage? Is there usually a limit?
No, you don't need to repeat it, because what it means is that the bank has ensured that it has secured that, and it makes you pay the insurance premium inclusive of the unemployment rider. All you need to do is to confirm with the financier that the premium or the cover that they have in place includes the unemployment rider. So,
thank you.
I was just saying that at the end of these presentations, on the slide that I'm showing, we have, you'll be able to contact us on email. You'll also be able to book an appointment if you want, if you would like further discussion on a one-on-one. You can also do a WhatsApp chat. It will come directly to me and I'll be able to respond back to you. So I can see we just have 5 minutes remaining. I don't know whether we have any other question that is remaining.
Hi.
Hello.
My question is this: for some of us, we are not employed, so we do not have the structured kind of income that allows you to make monthly contributions. Is our insurance policy structured in a way that you can make payments, not necessarily monthly, but provided you've covered your premiums for that particular period? Is there a possibility to do that, or it's always monthly?
It is possible. You can decide to pay your premium quarterly or half yearly or even yearly, so that you have a whole 12 months to reorganize yourself for the next premium payment.
Okay.
Yes.
Okay, thank you.
You're welcome. So I hope we have found this session useful. And this is a series, we are holding a series of these presentations. Next week, a time like now, we will have the next insurance series. That is on loss of health, insurance as a protector against loss of health. And the third one will be insurance as a protector against loss of life. And I think with that, if there is one more question we can answer, we have 3 minutes to our time. And I would just request that next time when we have a meeting, we make it on time so that we are not locked out. And also we minimize the disruptions in terms of the time required.
I have a question. Is it possible for you to share this presentation with us so that we can?
Yes, we will share the presentations. We will also put them on the YouTube, and they will be accessible. The other thing is that I can easily upgrade and update them. So any additional information that I'll need to, I will always give it in those slides. So they are not static.
Okay.
Yeah. So I think with that we can put it. I can see somebody, Tito, in an example given, a contribution of 5,000. Is that the lowest? No, it is not the lowest. This was taken purely for demonstration purpose, and you can pay as low as 2,000 depending on your earning capacity and what you can afford. I can see someone asking, you can take a policy as low as 2,100 in form of premium. And the good thing that I also need to add is that you are not restricted to taking one policy. When your circumstances improve, you can always boost yourself by taking another policy. But of course, you'll be older. So I think with that, we wind up the meeting, and I want to appreciate each and every last one of you, and pray that you keep safe until we meet in the next session. And I think our time is up. Feel appreciated, and I look forward to meeting most of you in the insurance market. Thank you. I did the meeting.